the Women Unleashed podcast. Join us as we share with you the confronting, fun, wild, fucked up, epic, and raw side of being a woman in today's world.
Come along on our journey as we dive deeply into what makes us tick and how we create our lives. Nothing is off limits.
Hello everyone and welcome back to the Women Unleashed podcast. We are your hosts Taylor and Britt, and today we are going to be talking about all things mortgages. So we've had a couple of episodes already where we talk about the home buying process, different deposits, costs, all that sort of thing. And today we're going to talk more around products and interest rates and what it actually looks like when you have the mortgage. So what you can get what type of mortgages you can have.
Ooh, this is exciting.
Yeah.
Alrighties. Well, let's dive on in, Taylor.
So I guess let's talk about like fixed versus variable home loans. That's probably the basic conversation. So the two, I guess, main home loans that we would look at is whether you would like a fixed loan or a variable loan. Now, a fixed loan is basically where you lock in an interest rate for a set period of time. So generally I would suggest no longer than 2 to 3 years just because of life changes. Because what can happen is if you break your fixed rate before the period ends, there's break costs involved.
Oh, okay. If you break, when you say, what does a break mean? What is it?
So if you say your fixed period, so we start the mortgage today and in 2 years' time, that's when the fixed rate expires. So then you would switch automatically to a variable. So if you break it, say, in 6 months' time, rather than the 2 years, you'll be hit with a fee by the bank.
And why would I want to break it?
So sometimes people separate.
Okay.
Sometimes they have to refinance to draw cash out for whatever reason. Maybe they sell. Maybe you sell your property.
Right, even in that circumstance.
Correct.
Okay.
Or maybe you want to leverage it to buy another house or something. So there's many reasons. Generally, you'd like to think people wouldn't, but that's why I always kind of say the 2 to 3 years is good, because that's when maybe things will change after 2 to 3 years, Yeah. So with the fixed rate, you lock that interest rate in for a set period of time and it won't move. So your payments will stay the same for that 2-year period, let's say. Generally, though, you don't get access to redraw or offset, and you can't generally put extra into the home loan or a lot extra in. So you can generally only put in $10,000 per year extra into the home loan without getting hit with a fee. Okay.
Right.
So there's just not as much flexibility with a fixed rate.
Okay.
But it gives you the stability and the knowledge to know that your rate will not change, not even if the market changes.
Yeah. Your cash flow is going to be the same.
Yeah. So it's just security. And as a first home buyer, it can be good too. It's your first time owning a home, your first time having a mortgage. So it can be good just to get into the swing of that as well.
Yeah. Okay. Interesting. I find it fascinating, but like the bank, it makes money off you, right? And the reason they don't...
Well, they are a business.
They are a business, yes. And the reason they put these things in place, like you can only pay 10 grand extra off your loan, is so that they can keep making money off you.
Yeah.
That's how it works.
Because they'd kind of project their figures based on you keeping that for a set period of time.
Yes.
So, if you change it or pay more off it, that's less interest and all that sort of stuff.
Yeah.
So, it's correct.
Oh, interesting. Okay. So that's a fixed loan. And what you said was, like, what's the maximum that banks offer in terms of the term of a fixed loan?
Generally 5 years.
Okay.
I think some of the bigger banks offer longer, but 5 years is probably your bigger.
Probably where it's at.
Yeah.
And then after that, it flips to a
variable.
Variable rate.
So whatever the variable rate is at the time,
that's
automatically what it'll go on to.
Right.
So the variable basically means that the rate can change depending on the market. So your rates will fluctuate based on what's being offered at the time.
Yeah.
However, there's more flexibility. So you can pay as much extra into the home loan as you want.
Okay.
And you have redraw and offset in most cases.
Okay.
So redraw is basically when you put like extra money into the home loan and you can redraw it back out of the home loan.
Okay.
So it's within the home loan, kind of that savings.
Yeah.
An offset account is a separate account to your home loan.
And separate to redraw?
Yep, and separate to redraw, because it's not, so redraw is in the home loan and offset's basically a transaction account, right?
Okay.
Or a savings account. And what it is it's linked to your home loan and it offsets the interest.
Mm-hmm.
So what that means is, let's say you have a $400,000 loan and you owe you owe $400,000 and you have $50,000 in your offset account. You're only paying interest on $350,000 rather than that $400,000.
Yeah.
So it works better. It works the same as redraw in the sense, like if you had an extra $50,000 sitting in redraw, you'd only be paying interest on $350,000 as well.
Yeah.
But sometimes people like that it's separate.
Okay.
But
more accessible? Is there another process you need to go through to redraw?
These days on internet banking, it's pretty easy for both.
Yeah.
And you can have a card attached to the offset account and things like that.
But not the redraw.
But no, generally not the redraw, no.
Okay.
And with the offset account, it's called like a package loan, generally.
Yeah.
You can have an offset, and sometimes you can have a credit card, things like that.
Yeah, that's what happened when I got my first place years ago. Yep.
But that comes with a fee. So generally it's $395 a year when you have an offset. So you kind of got to work out, are you a good saver, and are you going to actually have much money in that offset account? Because if you're not, I would suggest going with a redraw.
Yep.
Oh, and just to make sure we're all clear, this is all general advice, so please make sure you actually speak to someone before just making these big changes. So make sure you look at your individual situation as well. But yeah, if you're not a big saver, an offset account with that annual fee is probably not the best idea.
Yeah. Yep.
So.
Yep. Okay. One thing I wanted to ask you is if we can jump back to the variable interest rate, because we want to educate people at the same time. Like, my understanding, and correct me if it doesn't fit, basically when the Royal Bank of Australia, the RBA, changes the interest rate, the interest rate they set is the interest rate that it's called like the interbank interest rate that banks can borrow between each other. Right?
Yeah. So it's
So that's how much it costs like the banks to borrow money from each other and from the government, and then they then have to add a margin on top of that to then loan to us, right? So that's why it's important to, if you own a home and you have a variable interest rate, or you are wanting to own a home and you want to educate yourself on what the market's doing, is to actually follow the RBA announcements on interest rates, because they will, the first Tuesday of every month, they meet and they make a decision as to whether or not they're going to hold the interest rate where it is at, raise it or lower it.
Yep.
And then the banks will then pass on, not directly, sometimes they don't at all, and they get wrapped over the knuckles for that. But that's basically why it's kind of important to follow that.
Yeah, but it's also this interest rate rise and all of this is a massive topic at the moment. But fixed rates have been going up since about June last year. So June, July last year. So even though the cash rate hadn't moved, the fixed rate has.
Wow.
So the variable rates seem to be steady or dropping. Like they seem to not be increasing. But the fixed rates have been. So it does show that although there's that cash rate, banks are still going to do what they need to do. So yeah, fixed rates are definitely nowhere near as low as they were last year. Variable rates are still very competitive.
Yes.
So I guess for yourself, it's just figuring out what you're comfortable with.
Yeah. And generally, I just hit my hand on the table. The fixed rate will be a premium or more than the variable rate, because the bank takes the risk on locking in that rate, and so do you. But generally the bank wears the risk on if interest rates move higher than your fixed rate, then then they're basically losing on the money that they lend to you.
Yeah.
Which is why it's higher than the variable rate.
Yeah, generally it is always higher. But I mean, at the moment, like variable rates would need to change 5 or 6 times to get even close to fixed. So I would say, yeah, I mean, I'm not going to predict anything. Like, we are aware that interest rates are moving and they will have to go up because they can't really go any lower. So we are seeing that in the fixed. I'm not sure the variable, how much higher that will go. But I guess, you know, looking, like, let's kind of talk about the affordability side of it. When banks actually look at your affordability, so how much you can borrow and what works with your living expenses and your income and liabilities, all that sort of stuff, they always assess you at a higher rate than what you're actually going to be paying.
Okay.
So they generally add a 2.5% buffer to your rate.
Oh, really?
Yes.
Okay, cool.
Always. So if you, and then they'll sensitize your repayments, everything. So it won't just be the new loan that they'll add that buffer to. They'll generally add it to like your other home loans that you may have and things like that.
Ah, okay.
So when they are looking at your application, they don't just go, okay, the rate's 3%. That's the, no, they actually will assess you at 5.5%.
Wow.
To make sure you can afford it as well.
Cool. That's what I really wanted to know. You know, like as someone who looks for opportunities in the market and what could happen if interest rates go up. Yeah, 2.5%, right?
Yeah.
Wow.
But also you need to look at your budget because you know the repayments say $400 a week based on the interest rate. But like, what if it went to $600 a week? How's that going to look?
Yes.
You know, so we may be able to afford, like, that means you probably need to look at your living expenses and maybe not be getting takeaways and things like that.
Well, yeah, and it means you need to be authentic when you state how much your expenses are, like in applying for your loan. Because if you fudge that, you're doing yourself a disservice.
Yeah.
Really.
Yeah, and also, like, you can make adjustments too. Like, so be real about it and then go, hey, maybe where can I cut back? So maybe I don't need Netflix stand and Disney Channel. Maybe I just need one.
How many have you got, Taylor?
All of them.
You've got the Disney Channel too?
Yeah. They have some good stuff. But I actually share them with my mum. So she pays for some and I pay, we share them. So it's, and we'll pay, you know, my partner pays. So it's not all me.
Got it.
But, you know, Uber Eats, things like that. All that sort of stuff. And like talking about budgeting, that could be a totally other topic, but looking at budgeting. So maybe that will make that something else.
Yep.
But yeah, looking at all that stuff and seeing where maybe you need to like rein it back, and we can talk about those things too and go through all that. But yeah, when the banks look at you, they do look at that. They add that buffer in just to make sure for if interest rates rise, you know, you can afford it.
Yeah, awesome. Okay, cool. All right, so yeah, sorry, thanks. We just jumped back to the interest rate, and then you were explaining redraw and offset facilities, and packaged loans with credit cards and minimum fees. What else is available?
So I think we should talk about like the type of repayments.
Okay.
So you've got principal and interest and interest only. So principal and interest basically means you are reducing the loan. Like you're reducing the principal amount and you're paying the interest, obviously, that's added to the loan. So what that means is that you'll actually see your loan lower as you continue to make repayments. Yeah, decreasing, better word. Decreasing as you make your repayments. So you're actually paying down the mortgage, right?
Yep.
Generally, when you're buying an owner-occupied property, so a property to live in, you would always go principal and interest. Very rarely would banks actually lend interest only on an owner-occupied, right? Because they want you to reduce the debt to own that property because you're living in it. And, you know, you've got to look at retirement and things like that.
Yeah.
Interest only means you are only paying the interest. So the repayments will always be less than a principal and interest repayment. However, the debt's not reducing because you're only paying the interest.
Yeah.
Generally, investment properties, like investors, will put interest only. For many reasons, and this is where you need to talk to an accountant and financial planner and really discuss like what would be best for you in your situation. Generally with interest only though, it helps with cash flow because you're not paying that extra amount on the principal. And obviously if you've got multiple investment properties, having that little extra is helpful. There can be tax reasons. You know, maybe you want to focus on paying off your own OC instead, so you reduce that repayment, all those sort of stuff. But again, it's not always something we can give you a lot of advice on. You do need to get that advice from your accountant and financial planner as to what's best for you. But I guess that just gives you insight into what interest only and principal and interest is like.
Yeah.
Also, I guess kind of back to the interest rates as well. Generally, you will find the interest only interest rate is higher than your principal and interest. But it's the repayments generally higher on principal and interest because you're paying that principal.
Yeah.
But the interest rate's generally higher on interest only. And on investment lending, the interest rates are always higher as well than your own occupied.
Right. What I heard you mention in the last couple of episodes that you're potentially, if you're an investor, they accept like a lower deposit, but they're like charging you more on interest. Is that generally how things go, or maybe I've just like thrown a big spanner in the works? Or if you're an investor only, do they want more of a deposit?
Generally, an investor, they want more of a deposit.
Oh, okay.
So they generally want a 10%
okay.
in most cases,
Minimum.
plus costs.
Yeah. Yep.
So
okay.
that includes that lender's mortgage insurance.
Yeah, right.
So you got to remember that gets eaten up by some of the loan.
Mm-hmm.
There are few, like one lender or maybe two lenders that'll go to 95 on investment.
Mm-hmm.
And then there is another lender that does like a better rate on your owner occupier and a higher rate on your investor. It's a bit complicated, but there is that. But generally you need, like rule of thumb, 10%.
10%. All right. Cool beans. All right. What are the risks associated with going fully variable?
I guess, well, the main risk is that if interest rates rise, you're impacted immediately.
Yep.
So your repayment will change straight away.
Yep.
So, that's your cash flow and your budgeting and all of that can be interrupted quite quickly.
Mm-hmm. Yep.
So that's probably the main one, I think, with variable.
Okay. Yep. And what are the benefits of going fully variable?
So fully variable means that you just have that flexibility. So if you want to put as much extra into the home loan, you can with no penalty.
Mm-hmm.
If you want to have an offset account, you can, and same with redraw.
Okay.
So it's just that flexibility of being able to pay extra. And if you decided to sell or wanted to do something with the loan, there's no really associated costs with that.
Yeah.
There's your normal discharge fee, which is about $350.
Mm-hmm.
There's not an extra cost like with a fixed rate.
Yep. And you ride like the rate. So if it goes down, you get that.
Yeah.
If it goes up, you also pay for that.
Correct. So if it goes down, like that's obviously a benefit.
Yes.
But if it doesn't, then you're impacted by that.
Okay, cool. And then what's the main risk with fixed?
Well, I guess the main risk with fixed is if rates do go down and you've got the higher rate, you don't get the benefit of the higher rate.
Mm-hmm.
And there's also not that flexibility. So generally you don't have redraw and you don't have an offset account. Mm-hmm. And if you do pay too much extra, you can be impacted.
Okay. Yep. And therein lies what you said the benefit was, which was having that stability of the cash flow.
Correct. Yep.
Yep.
So just knowing you've locked that rate in for that set period of time is, makes people's minds comfortable.
Definitely. Okay. And do people have combos? I've heard, I've fixed so much and I've gone variable on so much. So it's called a split loan. Okay.
When you do that, so you can have a portion fixed and a portion variable, and then you get the best of both worlds. Mm-hmm. But it does mean you'll have two home loans. So some people don't. Some people don't like having two home loan accounts. Mm-hmm. So that means two different repayments will come out to pay each home loan.
Yeah. So two mortgages?
Two mortgages associated with the one property.
Yep. Okay, cool.
So you can have a variable with an offset account, say for, $200,000, and then you might have $300,000 in fixed.
Okay. Does that, sorry to cut you off, does that change the deposit that you also need? Or do they just pool it anyway? And
it's all just one. Yeah, it's like that's how much you're borrowing. It's just split over two loans.
Okay.
So I would say generally when I look at doing an offset account, I look at how much people can save over that fixed period. So if you can save, $500 a week, like I know it's a lot, but if you can save that, then we'd kind of make your loan based on what you can save. So if you can save over 2 years $50,000, we'd probably look at making the variable portion of your loan around 50 to 100,000, so that
okay.
the offset actually is basically offsetting.
Yeah.
And then the idea is you focus on paying that variable portion down.
Mm-hmm.
So you'll put as much extra as you can and keep your fixed repayment.
Yeah.
So that you're getting rid of that loan quicker.
Yeah. Okay. Interesting.
Hmm.
Very, very interesting. Huh. All right. What else about mortgage products or interest rates do you want to share with us today?
Just have a chat with your broker. That's probably my biggest point is like, don't try and figure it all out by yourself. Like, go and get the right advice and have a chat and look at what product works for you, because what product might work for me, say, you know, a fixed rate might work for me, but a variable is better for you. You just got to have a look at that and have a look at what your goals are in the future too. Because if you're planning on selling or doing things, you know, a fixed rate might not be the right thing now.
Yeah. So you don't need to do it alone.
No.
That's what you're saying.
So and just team up with someone that you feel comfortable with, that, you know, make sure you feel comfortable with that broker and have that transparency and get the right knowledge to make sure that you're choosing the right things for you and your family.
Awesome. Yeah, fantastic.
Cool.
All righty. Well, thank you, Taylor.
Thank you.
Such a wealth of information, and I can tell why you really, really love doing what you do. And thank you, everyone, for listening. We look forward to having you let us know how you go about sharing what you learn. So you can do that by leaving a review on our podcasts, on social media, you know, messaging or replying to our posts. And look, our goal is to become the #1 women's empowerment podcast in Australia. So the more people know about us, the better. So thank you so much, and we'll talk again soon.
See ya.